Canada's rarely looked this good for a stock market perspective relative to the US than is the case today.
I want to get your views now on the Canadian economy, and the Canadian electorate has a lot in common with the Americans. We're concerned about inflation, we're concerned about immigration, but there's one issue that we have that the Americans don't have, and that is a lack of leadership at the federal level. And just to provide some context for our viewers, our Prime Minister, Justin Trudeau, has resigned, and he's still the Prime Minister, and he's going to stay so until March when the Liberals have a leadership race. But until that time, there's a lot of turmoil, both at the federal level and at the provincial level, and we're really sailing without a rudder. And it couldn't happen at a worst possible time because we have this pending trade war with the US. And a lot of the troubles we're experiencing right now existed long before these recent troubles have started. The Canadian economy, as measured by GDP, has been in decline for many quarters now. Labor productivity has been in a decline for many years. Unemployment's ticking up. I believe the last number was 6.5% in the province of Ontario. I think the number is 7.5%. What's your view on the Canadian economy?
Okay, well, let's just say that starting off with your first comment about political instability, I would say that the U.S., a lot of people would agree that the U.S. was rudderless from a political leadership standpoint for 4 years. Canada's not alone. Look what's happening in the UK right now. Look what's happening in France and Germany. Political changeover in Italy and in Mexico. And Modi's power base eroded in the past year with their election. There's political upheaval around the world. There is dissatisfaction with incumbents around the world. Canada is not alone. So this will get resolved. We're going to have an election probably sometime, I would imagine, in the spring. And if you're going to ask me, no matter who wins the Liberal leadership, I think Pierre Poilievre probably emerges as the Prime Minister. And pro-business, pro-market, there's a lot of reasons to be hopeful about political change in Canada in that respect. So just like we were hopeful after we replaced Pierre Trudeau with Brian Mulroney, it wasn't the worst thing for the Canadian economy or the markets, or what it meant for deregulation in Canada, what it meant for tax reform, all the stuff that Mulroney did, which is really positive. And I think Poilievre will be very positive for the Canadian economy and the capital markets. I'm a capitalist, by the way, so other people might have a different opinion. But I think Poilievre, a majority Conservative government, will be a game changer. How we fight the tariffs, I don't know if we can. We'll see what Trump's going to do. I don't think there's much we could do about it, except cut interest rates dramatically and weaken the Canadian dollar. I think we get into a tit-for-tat trade war. And not good news for us. We ship over 20% of our GDP to the United States. The United States ships 1% of its GDP to Canada. It's not an even relationship. And I'm a little nervous that we're going to try to play tit for tat. Sometimes, you're fighting the bully in the schoolyard. You get a black eye. You try to fight back, good for you, then you get two black eyes. I'd rather not get two black eyes. So we'll see how these things unfold. But I think the political outlook in Canada is actually good. We were going to have an election anyways, no matter what, in October, and now we don't have to wait that long. So I'm taking a more optimistic view of the political outlook here in this country.
So you're confident about the political landscape, but what about the economic?
A lot of these things are out of our hands. If Trump brings on that 25% tariff, it's going to be horrible. I mean, there'll be a deep recession in Canada. It'll trigger a 2% decline in real GDP. That doesn't sound horrible, does it? But it is. GDP is not the stock market. It's as if I would tell you the stock market's going down 40%. The economy going down 2% is a big deal. We'd lose over 400,000 jobs, and the unemployment rate would go 2 or through 8%. Now, people think that we're going to respond. We'll see how we respond. We're going to choke off our exports to the U.S. I don't think that does us a whole lot of good. Are we going to have to take it? Maybe we will. I think there's other things that we could do to combat it, which is cut rates dramatically. And it's natural to have the country that's having the tariffs imposed, it's natural to have their currency decline as an antidote and at least a partial offset. And I think that's probably what's going to happen. We get into a trade war with the United States, that we slap on tariffs, we do a tit for tat. You know, I don't want to get into a prolonged fight with Donald Trump. We don't know where it's going to end. We only know that we need them more than they need us. So things are pretty weak as is. You could argue technically we're not in a recession, but let's face it, 7 consecutive quarters of negative real GDP per capita, not a good look. Justin Trudeau was the only prime minister Canada's had that presided over practically zero growth in productivity and zero growth in real GDP per capita. Nicely done. And we'll see what Poilievre could do, because we know that immigration is going to be constrained going forward, which is not the worst thing in the world, coming off the levels that we've had. What is going to happen to engender a productivity revival in Canada? Because that's really what's been missing from the supply side. But what I can say is that the negative aggregate demand shock from what the Trump will do, if he does what he says he's going to do, and not knowing what our response is going to be very bad news for the economy. Very bad news. And rates will come down, the Canadian dollar will come down, and you can make an investment thesis in the Canadian stock market right from there. It will not be nearly as bad for the Canadian stock market as it will be for the Canadian economy. But just remember that the TSX, like the S&P, is not part of it, so it's not GDP. But there's going to be important areas to focus on bullishly in Canada if these tariffs come through. You have to know what to avoid and what not to avoid.
You just mentioned the Canadian dollar, and I should have mentioned that it was down 10% in 2024. It's at a 14-year low against the USD. Where do you see the Canadian dollar going?
Well, I think that if Trump does, as advertised, this 25% blanket tariff, I think the bank will have to take, we're already gone from 5 to 3.25 on the policy rate. I think we'll go down well below 2% into the ones. Canadian dollar in this environment, because the Fed will be on hold, the combination of the shock and what the Bank of Canada will do leads us to a conclusion that the Canadian dollar will get to around 160, so call it 62, 63 cents. And that'll create winners and losers. I think that it obviously is going to have an impact on food prices, and that's the most important thing. And I think that, as I said before, despite the horror narrative, our fiscal policy is not out of control. The U.S. is far worse. We can afford to have rebates for low middle-income households to offset the shock, especially on food. I mean, other stuff won't go up. I mean, rents won't go up. But imports prices will go up, especially for things that you need to live. The government has to protect those people. Maybe not me or you, but there should be a system. That's what I would be thinking about instead of playing tit for tat, choking off oil, electricity, all this other stuff. That's not going to help our economy. Okay, it's like bringing a butter knife to a gunfight, and I don't recommend that. There's other ways that we can cushion the blow. I think we got to focus on cushioning the blow, not teaching Donald Trump a lesson. That is not going to end well for us. That's also a memo to Doug Ford. It's not going to end well for us, okay? We got to deal with the situation. And I think that we should play defense and think about how we're going to cushion the blow rather than retaliate. That's my advice. But the Canadian dollar will weaken, and that's going to create a travel and tourism boom in Canada. Can I quote Donald Trump? At travel and tourism in Canada, like nobody's ever seen. And because Americans will see, like right now it's 40% discount, 60% discount on the Canadian dollar. They're not going to spend 1 week in Quebec City or Whistler, they'll spend 2. Travel, tourism, accommodation will be a boom. I think the airlines, cross-border, Because what's Trump going to do about that? What's he going to do? Is he going to have troops at the border? You can't go into Canada. The way you get back at Americans is have the currency so cheap that they're going to, he wants to create a 51st state. But maybe there's a lot of Americans that are going to be staying a long time in Canada because look at what the US dollar buys in Canada. We were talking before about, went out for dinner at this high-end local establishment on Avenue Road that everybody knows. It's a great restaurant. And a client of mine was there from the States, a firm, and they invited some other investors. There's 10 of us in the restaurant. And the head sales guy who took everybody out from New York could not believe. This is one of the most expensive restaurants in Toronto. He said, can't believe how cheap this is. I said, well, the Canadian dollar is 144. Wait till it's 160. When it's 160, like you'll be ordering a bottle of Dom Perignon, So that's actually, how we will get back at the Americans. And then, of course, the comeback is, well, that's going to really hurt us from imported inflation. Well, the imported inflation that's going to be most important from a social policy standpoint is food. Okay, but there's a way through fiscal policy that we can also circumvent that blow to low and middle income households. That's what I'd be doing if I was in Ottawa.
So you've expressed a lot of concern about the U.S. economy and also the Canadian economy. What are you recommending to investors? How should they position themselves during this time of uncertainty?
Well, let's talk about the stock market first. I said before, the U.S. is in a different orbit. Great companies, stocks are they're in nosebleed terrain. The only stock market in the world that is a 2.3 standard deviation event, that is extreme. No country shares that dynamic. Well, some of the cheapest markets in the world, for example, are in emerging Asia. As Don Cox famously said, emerging markets are markets that you can't emerge from in an emergency. So and of course, China is a big part of the emerging market world, and they're going to get hit with a tariff, and they're dealing with the ongoing aftershocks of their the bursting of their property and debt bubble. Question marks around China, but you have some of these countries have single-digit price earnings multiples. You're salivating as an investor, but then you start thinking, as you're going back and forth, do I put money in emerging markets? But maybe they're cheap for a reason. Maybe they're cheap, but they're cheap for a reason. Okay, then you go to Europe, same thing. The European market, dirt cheap. You have all this political instability especially in Germany, France, the UK. UK is a very cheap stock market, very attractive, but you've got fiscal problems. The problems over there are much worse than they are in Canada, okay? Their inflation is more sticky. Canada does not have sticky inflation. And Canada doesn't have really a massive fiscal problem. We talk about it a lot. There's a big household debt problem in Canada. Europe is cheap, but maybe once again, like emerging Asia, maybe it's cheap for a reason. Canada's trading at a 15 forward price earnings multiple. When you look at the Cape, we're trading bang in lines, very strong neutral. We're not anywhere close to 2.3 standard deviations. We're just closer to the norm. US is trading at a 22 forward multiple, we're at 15. 7 multiple point gap. It's almost unprecedented. It's like Canada's for sale. When something goes on sale, you normally want to buy it. Not just that, and I didn't mention this before, but look at the bond yields that the TSX is competing against. The bond yield in Canada is what, 3.25%. In the United States, it's 4.6. The US market is competing with a 4.6% 10-year Treasury note yield. What has happened in the US, which is truly ridiculous, is you have an equity risk premium of 0. You have an equity risk premium of 0. The ERP is 0. What does that mean? It means that you're not getting paid as an equity investor to take on equity risk. The market is, we start off talking about the market. What is the market telling us? The stock market in the United States is telling you that equities have become a riskless asset class. Equities have become a riskless asset class. Think about that for a second. Equity investors are putting the S&P 500 on the same risk characteristic as Treasury bills. Well, Jimmy, how do you feel about that? I know how I feel about that. When you have the equity risk premium at zero, the market's telling you this collection of 500 stocks, it's not totally 500, are basically collectively zero beta. There's zero beta. Last time this happened, late 90s. I'm just not good enough to know, is it like 97, 98, or is it 99? But I know that I'm not going to chase nickels, dimes, and quarters in front of the steamroller right now. The train has left the station. So in Canada, quite a bit of difference because the equity risk premium in Canada is 3%. You get paid. You get paid to take on equity risk in Canada. The stock market is paying you to take on that risk. In the United States, the market is not paying you to take on that risk. Not just that, but look at the dividend yield. The dividend yield in the S&P 500, do you know what it is? You know what it is? It's 1.2%. Does that get you excited? Doesn't get me excited. I like dividends. I'm like Mr. Wonderful. Cash flow. Canadian, the TSX dividend yield, 3.2%. Really? That sounds enticing to me. And so when I take a look at what's going to happen in Canada, which was already happening before the tariffs come, it'll reinforce it. Much lower rates with your Canadian dollar. The tariffs come, you got to avoid the stuff getting hit by the tariffs, which is industrials, consumer goods, basic materials. But there's going to be a lot of stuff like, what tariff is Trump going to put on the banks? Is there a tariff he can put on the bank? He's not putting tariffs on services. He's putting them on goods. So you want to own the stuff that's going to do well with lower rates and a steeper yield curve. Financials, REITs, utilities, telecom services. And the weaker Canadian dollar is going to be a boon for travel and tourism. All the stuff I'm talking about right now that's going to benefit from lower rates and a weaker dollar accounts for 50% of the TSX. The stuff that's going to get hit by the tariffs, that's 30% of the TSX. So people will be surprised that even though this is going to be horrible for the economy, it won't be nearly as horrible for the stock market, and especially if you're in the right sectors. So I wrote this report at the beginning of the year that said, the title was Attention US Investors, Leave New York and Come to Toronto. Because don't forget, the added kicker for them is they're getting the Canadian dollar. Even if we go to 160, we're going to be closer to the lows than we are to the peak. We were last at that level in 2002, around the SARS shock, if you remember, and the bank was cutting rates without the Fed. We didn't stay at 62 cents indefinitely. So Americans get to pick up a much cheaper market with a much better yield in a much cheaper currency. And I tell this to because 70% of my clients are in the States. And I want them to stay out of trouble, and I want them to make money in a prudent way. Canada has rarely looked this good. Despite all the warts, scars, and pimples, Canada's rarely looked this good for a stock market perspective relative to the US than is the case today.
And the last time we spoke, you were very bullish on precious metals. Are you still?
I'm still I am a long-term bull on gold, absolutely, and precious metals in general. Why? Because the first thing you brought up, Jimmy, you talked about uncertainty. The word uncertainty showed up 12 times in the latest FOMC minutes. It showed up 6 times in the beige book. We are uncertain with a capital U, bolded, and gold is an effective hedge. There's other attributes. Gold is an effective hedge against uncertainty. And the world's always uncertain, but we're in a different level right now. Like, you want to talk about standard deviations of benchmarked against the norm. We are way above that. So gold is a good hedge against instability. And with all the political instability, what's Trump going to do, not do? And it can go either way. Gold is going to offer up that diversification, bastion of stability in a portfolio in an uncertain world. I think that makes perfect sense. So the answer is yes, I'm still very bullish on bullion.
Nothing better than gold in the hands. Well, David, this has been a great conversation, and I want to thank you very much for sharing your thoughts. If somebody would like to learn more about you and your research firm, Rosenberg Research, where can they go?
So you can just Google Rosenberg Research, and it'll pop right up, and you can surf our website and take a look at what we're doing. And there's a way on the website as well to get to access a free trial, so you can trial us for free. And short of that, you just have to go to just Google information at rosenbergresearch.com, information at rosenbergresearch.com, and sign in. One of my client service representatives will get in touch with you. And again, you can taste our wares, read our research. We'll get you on a trial, and then hopefully you'll become a client. You know, we have almost 3,000 clients in 40 countries, and half are general investors, the general public, what we call, quotes, the retail investor, and the other half are institutions. And we cover the world, both in terms of economies and markets. And that's the pitch.
David, once again, thank you.
You as well.